very warm welcome to all of you. I hope you and your loved ones are safe and maintaining good health. Today, I'm going to share with you some key highlights of a recent CRISIL Ratings study on the business prospects for asset reconstruction companies or ARCs and how the MSME and retail segments may be their go-to segments in the days ahead. Now, ARCs are expected to circle stressed accounts in the micro, small and medium enterprises and retail segments in the near to medium term, given the twin challenges of inadequate funding access and intensifying competition once the proposed national ARC materializes. ARCs have already been facing headwinds in the past two fiscals, with assets under management as measured by security receipts outstanding contracting after a strong run-up in the previous 5 fiscals. Between fiscals 2015 and 2019, their AUM had expanded steadily on the back of supportive regulations introduced in fiscal 2014. But that trend reversed in fiscal 2020 with a 4% contraction in AUM. In fiscal 2021 too, as per CRISIL Ratings estimates, their AUM contracted by 1%. Against this backdrop, CRISIL Ratings believes that the stressed asset space will see segmentation, with various players having different focus areas. Availability of capital, debt aggregation capability, and operational infrastructure will define the positioning of each player. The national ARC, given its stated mandate and access to capital, is expected to dominate the large corporate segment. Mid-corporate assets, where ARCs have a relatively better recovery track record, could be a play for them as well as for stressed assets funds. In the retail and MSME segments, however, ARCs have the opportunity to create niches. These segments need an operationally intensive setup that other investor classes are unlikely to be interested in creating. Given the higher OPEX needed, volume will be key to profitability. So ARCs that invest will need to maintain a sharp focus on this segment. At the same time, ARCs have yet to demonstrate their recovery capability in the retail segment on a material scale. However, one factor will support their shift towards retail and MSME segments. It is the opportunity in the form of incremental NPAs coming largely from these two segments in the current cycle, with lenders, including non-banks, increasingly putting these assets up for sale. In fact, this shift is visible already. Although overall volume of debt acquired was lower in fiscal 2021, a CRISIL rating study shows non-corporate segments formed a significant 44% share, which is a stark increase from 4% 2 years back. Overall, with other segments seeing greater competition in terms of alternatives for lenders, greater participation in the retail segment is perhaps an inevitable shift. As before, the ability to collaborate with other investors, bringing in capital in various forms, and fundamentally demonstrate recovery capability will be the key to long-term growth and profitability. And on that note, I thank you for your time and attention. Until we meet again with another topical theme, goodbye.